So you might have seen the news. India's Reserve Bank, the RBI, is taking a close look back. 9 years of its inflation targeting framework are under review right now. And this isn't just some dry policy update. It's really crucial if you're tracking India's economy or maybe, prepping for exams like UPSC. So today, let's dive into that. We'll unpack India's journey with inflation targeting, basically from 2016 up to now 2025. We want to get a handle on what it is, how it actually works on the ground, and what difference it's made.
Absolutely. And inflation targeting, really, in a nutshell, it's a strategy, a monetary policy strategy, where the central bank, the RBI in this case, sets a specific goal, an ideal rate for inflation. India officially jumped on board in 2016. The target was set at 4%, but with a band plus or minus 2%, so anywhere between 2% and 6%. That target range was then extended back in 2021. What's interesting is India's band, that 2%, 6%, it's actually wider than you see in many developed countries. That reflects, well, the unique challenges like supply shocks, food prices, and also the strong growth needs of a developing economy like India's. The whole idea rests on this belief that stable prices are the foundation for healthy long-term economic growth.
Okay, so we have this target range, 4%, give or take 2%. How does the RBI actually, steer the ship towards that? What levers do they pull?
Right. So central banks use these targets as a guide for their day-to-day or rather month-to-month monetary policy decisions. The main tool, it's usually adjusting interest rates. The process involves looking ahead, forecasting where inflation is likely headed, and then you compare that forecast to the target rate, that 4%. The gap between the forecast and the target tells them how much they might need to tweak monetary policy, tighten things up, or maybe loosen them. There's a model often mentioned, especially for learners, called the Taylor rule. It basically suggests, raise interest rates if inflation's too high or if GDP growth is running hotter than desired, and cut rates if it's the other way around. But in reality, for India's MPC, it's often more complex. You have things like sudden spikes in food prices, which the basic Taylor rule doesn't handle perfectly. It needs judgment calls.
Okay, so the Taylor rule is like a theoretical guidepost, but not a rigid map. So who's making these crucial judgment calls? Who's actually in the driver's seat?
That leads us straight to the Monetary Policy Committee, the MPC. It's a 6-member committee. You've got 3 people from the RBI itself, and the RBI governor is the chair. And then there are 3 external experts appointed by the government of India. They serve for 4 years. Their main job, setting monetary policy, specifically deciding on key interest rates like the repo rate. That's the rate banks borrow from the RBI, and it influences all other lending rates in the economy. What's really key and quite fascinating is how they have to balance keeping inflation near the target with, well, supporting economic growth, especially during tough times like crises. Think about the start of the COVID pandemic. The MPC didn't just slash rates across the board. They also used very specific targeted measures to inject liquidity where it was needed most. It showed they can be quite adaptable, recognizing that a simple rate cut might not fix specific problems in different sectors.
That's a lot of power and responsibility. How is the MPC held accountable? How do we know they're sticking to the mandate?
Good question. Accountability is actually built right into the framework. There's a legal requirement. If inflation goes above the upper limit, so above 6% for 3 quarters in a row, the RBI has to formally report to the government. And that report needs to explain why it happened and, crucially, outline the steps they plan to take to bring inflation back down. This really does enhance their responsibility. It gives the framework some teeth.
Okay, makes sense. So let's talk results. We've had this framework since 2016. What's been the actual impact on the Indian economy?
Right, the impact. Well, firstly, and most obviously, we saw better inflation control. If you look at the average inflation before the framework, it was around 6.8%. After adoption, it's stabilized, averaging about 4.9%. That's a noticeable drop. Now, that stability is good for consumers, for businesses planning, but it also meant sometimes credit conditions might have been a bit tighter than some sectors would have liked. A trade-off, really. Secondly, a big plus has been flexibility. The MPC showed it wasn't rigidly focused only on inflation. You could shift focus, especially towards supporting growth during crises like COVID, as we mentioned. That responsiveness is vital. Then there's the accountability we just discussed, that formal reporting if the target's breached. That helps maintain discipline. And very importantly, transparency. The minutes of the MPC meetings, they're published just 2 weeks later. So the public, the markets, everyone can understand the reasoning behind their decisions. That builds credibility. And finally, just the structure itself, having 6 members with diverse backgrounds, internal and external. It leads to more inclusive decision-making.
It helps avoid, groupthink, which can sometimes happen when just one person or a very small group makes all the calls.
So a framework adopted, extended, used for nearly a decade. brewing some clear benefits like stability and transparency. But now, as we said at the start, the RBI is reviewing the whole thing: performance, structure, everything.
Exactly. And that review naturally raises the big question: what comes next? The future of the framework is definitely a hot topic right now. It's about balancing the successes we've seen against, well, new economic challenges, the changing global picture. The debate now is really about how to potentially tweak it or adapt it based on everything we've learned over these past 9 years.
So, wrapping this up for you, our listeners, what's the key takeaway? Inflation targeting clearly brought a new phase of, let's say, relative stability to India's monetary policy scene. It provided a much-needed anchor. But now, India is actively debating its next steps, how this framework might evolve. Definitely something to keep an eye on as you continue tracking India's economic story.